All right, let's dive into an overview of product portfolio management and see how it shapes the way companies approach their product development processes. So, what exactly is product portfolio management? It's essentially about managing all your products in such a way that you maximize their value while aligning them with your company's strategy and goals. Now, why do we need to manage our product portfolios this way? Well, it helps companies stay competitive by ensuring they're always focusing on the right mix of products. Think of it like balancing investments. Some might be high risk but offer big returns, while others are steady and reliable. In product portfolio management, you're looking at your current offerings and potential new ones to see how they fit together. To do this effectively, companies often use what's called a portfolio matrix or a similar tool that helps visualize the different products based on their market performance and strategic importance. This could be things like high-growth markets versus mature markets, or innovative technologies versus established solutions. Another key aspect of product portfolio management is understanding the life cycle stages of each product. Some might be in the development phase, others are growing rapidly, some are stable, and a few might need to be phased out as they no longer align with your overall strategy. By managing these life cycles effectively, you can ensure continuous innovation and growth. It's also important to consider how different products complement each other or even compete within the portfolio. For instance, if you have two similar offerings targeting slightly different market segments, it might make sense to consolidate them into one product for better efficiency. Or perhaps you see an opportunity to expand your portfolio by adding a new line of products that fits well with existing ones. Additionally, when managing a portfolio, companies often look at financial metrics like return on investment and profitability alongside strategic goals such as market leadership or customer satisfaction. This dual focus helps balance short-term needs with long-term vision. So, in summary, product portfolio management is all about making smart decisions to optimize your products for maximum impact and alignment with company strategy. It involves analyzing the current state of your offerings, predicting future trends, and adjusting accordingly to stay competitive and innovative. Now that we've covered this overview, you should have a good grasp on why managing your product portfolio effectively is crucial for success. All right, everyone, let's dive into why effective portfolio management is so crucial and how it can benefit you in numerous ways. Picture this. You've got a diverse collection of investments, stocks, bonds, real estate, maybe even some high-ticket art pieces. Now imagine if all these assets were managed poorly, like leaving them unattended or investing without a clear strategy. It could lead to chaos and potentially lose you money instead of growing your wealth. But with effective portfolio management, you're taking control of that collection of investments, ensuring they work together seamlessly to achieve your financial goals. This means regularly reviewing performance, rebalancing as needed, and making strategic decisions based on market conditions and personal needs. One major benefit is diversification. By spreading your investments across different asset classes, you reduce the risk of big losses if any one area tanks. It's like not putting all your eggs in one basket, a classic but effective strategy to protect your wealth. Another key advantage is achieving better returns. With proper management, you can identify high-performing assets and allocate more resources there, while trimming back on those that aren't performing as well. This dynamic adjustment ensures you're always optimizing potential earnings. Moreover, managing your portfolio effectively helps you stay ahead of changing market conditions. Whether it's shifting interest rates or economic trends, a well-managed portfolio is more resilient and adaptable to these shifts. It's like being able to pivot quickly in business. You react faster to changes and capitalize on opportunities. Lastly, effective management also means you're better prepared for long-term financial planning. Whether it's saving for retirement, funding education, or securing your future, a carefully managed portfolio helps you meet those goals more efficiently by ensuring steady growth and savings over time. In conclusion, mastering the art of portfolio management is essential for anyone looking to grow their wealth and secure their financial future. By diversifying effectively, optimizing returns, staying adaptable to market changes, and planning strategically for long-term goals, you can ensure your investments work in harmony to achieve success. Let's dive right into today's topic: aligning products with business strategy. Imagine your company as a ship navigating through uncharted waters towards a destination. That destination is your overall business goal. Now, think of each product line as one of the sails on the ship. If all the sails are pointing in different directions, you won't move forward effectively. But when they're aligned properly with your strategy, every gust of wind can propel you closer to achieving your goals. To start off, let's break down what business strategy is and why product alignment matters so much. A strong business strategy defines where your company wants to go, its vision and mission, while also spelling out the specific steps needed to get there. That's the tactical part. It includes identifying target markets, defining key strengths and competitive advantages, setting financial goals, and laying out a timeline for achieving those goals. When you align products with this strategy, everything becomes more focused and effective. For example, if your business aims to dominate the high-ticket luxury market segment, then every product should cater to that customer base in some way, whether it's through features, pricing, or marketing messaging. The same goes for a company targeting young tech-savvy consumers. Their products might emphasize innovation and cutting-edge technology. Let's take a quick look at how this alignment happens in practice. First, you need a deep understanding of your business strategy. What are the core objectives? Who are your key target markets? What makes your products stand out from competitors? Once you have these details clear, it becomes easier to design and market products that fit seamlessly with the overall strategy. For instance, if expanding into new geographic regions is part of your growth plan, then developing localized versions of your product or tailoring marketing efforts for those areas could be a key step. Or maybe increasing profitability is your main goal in this case. Focusing on high-margin products might make more sense than investing heavily in low-margin items. Another important aspect to consider is how product lines can support broader strategic initiatives. For example, if you're aiming for sustainable growth, then eco-friendly or recyclable materials could become a feature of your products, appealing to environmentally conscious consumers while also supporting this long-term goal. To make sure everything stays on track, regular reviews and adjustments are crucial. As market conditions change or new opportunities arise, reassessing product alignment with business strategy helps you stay agile and responsive. This might mean pivoting to new product lines or discontinuing those that no longer serve your strategic aims. So there, you have it. Aligning products with business strategy is all about ensuring every aspect of your company works together towards achieving its overall goals. By understanding where your company wants to go and how each product fits into this picture, you can create a cohesive portfolio that propels your business forward effectively. That wraps up our discussion for today. Remember, successful alignment isn't a one-time task, but an ongoing process that requires regular review and adjustment. All right, let's dive into defining our portfolio goals and objectives. To start off, imagine you're building a house. Wouldn't it feel odd to just pick up tools without knowing what kind of house you want? Same with your investment portfolio. We need clear goals and objectives that guide us. So first things first, what are we aiming for? Are we looking at long-term growth or perhaps generating regular income? Maybe we're focusing on high-ticket assets for the future. Or maybe it's a bit of everything. That's okay too. The key is to know what you want from your portfolio. Next up, let's talk about objectives. These are the specific targets within our overall goals. For instance, if growth is our goal, we might set objectives like reaching a certain net worth in 10 years or increasing investment returns by 5% annually. Objectives give us tangible benchmarks to measure progress against. Now, how do we define these? Start with your current financial situation. Assess where you're at now and what needs improvement. Then look ahead at your life stages and priorities: retirement, children's education, buying a home, whatever it may be. Aligning your portfolio objectives with these personal milestones makes them more meaningful. Another important aspect is risk tolerance. Are you comfortable taking on high-risk investments for potentially higher returns, or do you prefer lower risks despite slower growth? Understanding your comfort level helps tailor the portfolio to fit your needs. Lastly, remember to review and adjust goals and objectives regularly. Your financial situation changes over time, as does market conditions. Regular check-ins ensure that your portfolio stays aligned with your evolving aspirations. So there you have it. Defining clear goals and objectives for your portfolio sets a strong foundation for success. It's all about knowing what you want and working towards achieving it step by step. All right, everyone, let's dive into today's topic: analyzing current and future market trends. Understanding market trends is crucial because it helps us stay ahead of the game, anticipate changes, and make informed business decisions. First off, we need to look at what's currently happening in the marketplace. We can do this by analyzing sales data, customer behavior, and emerging technologies. For example, right now there's a high demand for sustainable products due to increased consumer awareness about environmental issues. This trend is not just here today, but will likely continue growing into the future. Moving on, let's talk about predicting future trends. To do this effectively, we need to look at broader economic indicators and global changes. For instance, as technology continues to evolve rapidly, it's becoming increasingly important for businesses to adapt or risk falling behind. The rise of artificial intelligence and automation is reshaping industries in ways we're only beginning to understand. Another key factor to consider when analyzing future trends is demographic shifts. As populations age and new generations enter the workforce, consumer preferences are changing dramatically. For example, Generation Z values experiences over material goods and prefers brands that align with their personal values. Lastly, don't forget about geopolitical events, which can significantly impact market trends. Trade wars or political instability in certain regions can affect supply chains and pricing structures, making it essential for businesses to have contingency plans in place. In conclusion, by keeping an eye on current developments and being proactive about future changes, we can better position ourselves to capitalize on emerging opportunities and navigate challenges successfully. All right, let's dive into our next topic: understanding and prioritizing customer needs. Imagine you're standing in front of a customer who needs something important for their business or personal life. How do you know what they really want? It's all about listening carefully to their concerns and figuring out which ones are the most pressing. First things first, let's talk about identifying those needs. Picture yourself having a conversation with them. Pay close attention to what they're saying and, even more importantly, how they're saying it. Are there any words or phrases that stand out as particularly stressed? These could be clues pointing towards high-priority needs. Next up is understanding these needs in depth. This involves asking some follow-up questions. For example, if a customer mentions they need something for their business to grow, you might ask how exactly this will help them achieve their goals or what specific challenges they're facing right now. Now that we've identified and understood the needs, it's time to prioritize them. Not all needs are created equal. Some might be urgent while others are more long-term aspirations. Think about which ones directly impact your customers' immediate success and satisfaction. High-ticket items or critical services often fall into this category. To help with prioritization, you can use a simple scoring system. Assign each need a score based on its urgency and importance to the customer's overall goals. This way, you can easily see which needs should be tackled first. Once you've got your priorities straightened out, it's crucial to communicate these back to the customer. Let them know what steps you're going to take next and how each need will be addressed. Transparency builds trust and shows that you're on top of their requirements. Lastly, don't forget about follow-ups. After addressing a few initial needs, Check in with your customers again to see if anything else has come up or if the priorities have shifted. This ongoing dialogue helps ensure you're always meeting their evolving demands. So there you have it. Identify customer needs through attentive listening and questioning, understand them thoroughly, prioritize based on urgency and impact, communicate clearly about next steps, and maintain regular follow-ups to stay aligned with their goals. By following these steps, you'll be well equipped to deliver the best possible service and build lasting relationships. That's all for now. Let me know if you have any questions or need further clarification. Let's dive into the world of portfolio management and explore how we can measure success through key performance indicators, or KPIs for short. Imagine your investment portfolio as a garden where every plant represents a different asset. Just like you want to know which plants are thriving and which need attention, it's crucial to track specific metrics that tell us if our investments are doing well. First off, let's talk about return on investment, or ROI. This tells us how profitable each part of our portfolio is. It's calculated by dividing the net gain from an investment by its cost. A high ROI means we're making good money on our assets. But remember, just focusing on ROI might not give you the whole picture. Another important KPI to watch out for is Sharpe ratio. This one helps us understand how much extra return we're getting for each unit of risk taken. It's like comparing apples and oranges. If your portfolio has a higher Sharpe ratio, it means it's performing better relative to its risks compared to others. Then there's the alpha, which measures how well your investments are doing against market expectations. If you have a positive alpha, that means your investment is beating the market benchmark. It's like getting ahead of the pack in a race. Not forgetting about diversification, we need to consider the correlation coefficient between our assets. Low correlations mean different assets aren't moving together all the time, which helps reduce overall risk. Think of it as not putting all your eggs in one basket. Lastly, let's touch on the volatility, or standard deviation of returns. This tells us how much the values are fluctuating over a period of time. Lower volatility is generally desirable because it means less risk and more stability. So there you have it. These key performance indicators give us insight into the health and success of our portfolio management efforts. By regularly checking these metrics, we can make informed decisions and adjust our strategies as needed to ensure long-term success and growth. That wraps up our discussion on KPIs for portfolio management today. Today, we're diving into how to measure success and identify areas for improvement. So let's get started by looking at why measuring success is so important. When you know what success looks like for your project or goal, it becomes easier to track progress and stay motivated. First up, let's talk about setting clear goals. Goals give us direction and help us focus on what needs to be done. They're the foundation of everything we measure. So before we start measuring anything, make sure those goals are specific, measurable, achievable, relevant, and time-bound. That's the famous SMART criteria. Next comes selecting appropriate metrics. Think about what exactly you want to measure to know if your goal is being achieved. For example, if you're selling a high-ticket item, sales numbers could be a good metric. But don't forget about qualitative measures too, like customer satisfaction or market share. Now that we've got our goals and metrics set up, it's time to start measuring regularly. Consistency is key here, whether it's weekly, monthly, quarterly. Make sure you're tracking progress at regular intervals so you can see trends over time. Once you've been collecting data for a while, analyzing the results becomes crucial. Look for patterns or changes that might indicate successes or challenges. This is where visual aids like charts and graphs can really help to understand complex information quickly. After analyzing your metrics, it's important to reflect on what they mean for your overall progress towards those goals. Ask yourself questions like, are we meeting our targets? Why are certain areas performing better than others? Now comes the nitty-gritty part, identifying improvement areas based on this analysis. Maybe there's a specific process that needs tweaking, or perhaps it's about expanding into new markets to increase sales numbers. Lastly, Don't forget to celebrate your successes along the way. Recognizing achievements helps keep morale high and motivates everyone involved to continue striving for those goals. So, in summary, measuring success involves setting clear, smart goals, selecting appropriate metrics, tracking progress consistently, analyzing results thoroughly, identifying improvement areas honestly, and celebrating milestones regularly. By following these steps, you'll be well on your way to achieving sustained success in any project or goal you set out to accomplish. All right, let's dive right into identifying risks across your portfolio. Imagine you're looking at a garden full of plants. Some are thriving beautifully, while others might need more attention to survive. It's similar with managing a portfolio. We need to identify which areas could use extra care or face potential challenges. First off, start by understanding the different components within your portfolio. Break it down into smaller segments such as investments in stocks, bonds, real estate, etc. Each of these elements carries its own set of risks and rewards. It's crucial to assess each one individually before looking at them collectively. Next, gather all relevant information about these components' market trends, economic forecasts, historical performance data, and any regulatory changes that might affect your portfolio. This step is like getting the soil analysis for gardening. You need to know what conditions your plants are growing in. Once you have this detailed information, it's time to evaluate potential risks. For example, high-ticket assets may be more susceptible to market fluctuations, while diversified investments can offer protection against single-asset risks. Think about these risks as potential threats lurking around each corner of your garden. Some might be obvious, while others could sneak up unexpectedly. Don't forget about the nitty-gritty details that can make a big difference. Even small changes in interest rates or foreign exchange rates can have significant impacts on certain assets. It's like noticing how different plants react to slight changes in sunlight or water availability. After identifying these risks, it's important to prioritize them based on their potential impact and likelihood of occurrence. Some risks might be low-hanging fruit that are easier to address, while others could require more time and effort to mitigate effectively. Just as you'd focus first on watering the plants showing signs of wilting before moving on to those thriving. Lastly, develop strategies to manage these risks. This can range from hedging investments through derivatives to reallocating assets in response to changing market conditions. Think of it like adjusting your irrigation system. Sometimes you need to change how water is distributed based on seasonal changes and plant needs. In conclusion, identifying and managing risks across your portfolio is a continuous process that requires regular monitoring and adjustments. By breaking down each component and evaluating potential threats, you can better protect your assets and ensure steady growth over time. Today, we're going to dive into some effective strategies for mitigating risks in any project or business venture you might be undertaking. Understanding these strategies can help you avoid potential pitfalls and achieve smoother sail through your endeavors. Let's start by looking at identifying the risks first. You see, before you can mitigate them, you need to know what they are. So take some time to thoroughly assess every aspect of your project or business. Look for any possible hazards that might crop up down the line. Once you've identified those risks, you can move on to evaluating them based on their likelihood and impact. This will help prioritize which ones warrant immediate attention. Next comes the fun part: developing strategies to tackle these risks head-on. One common approach is risk avoidance, where you simply steer clear of any activities that might trigger a high-risk event. For example, if you're launching a new product and there's a significant chance it could fail due to market saturation, perhaps it's best to wait until the market conditions are more favorable. Another strategy is risk reduction. This involves taking steps to lessen the impact or likelihood of risks occurring. Think about investing in high-quality materials for your project to reduce the chances of defects cropping up later on. Or maybe you're running a business and implementing robust cybersecurity measures to minimize data breaches. Risk transfer is another tactic, where you pass some responsibility for managing the risk onto someone else. This can often be done through insurance policies or contractual agreements that specify who's responsible if things go awry. Lastly, there's risk acceptance. Sometimes, despite your best efforts, certain risks simply can't be avoided or transferred. In these cases, it might make sense to accept them and plan accordingly. By employing a mix of these strategies, avoidance, reduction, transfer, and acceptance, I will be better equipped to handle any risks that come your way. Remember, the key is to stay proactive and not let potential hazards catch you off guard. So there you have a comprehensive look at how to mitigate risks in your projects or businesses. I hope this gives you some valuable insights into managing risks effectively. All right, everyone, let's dive into today's topic: determining optimal resource distribution. Imagine you're managing a team or running a business and you have limited resources, but plenty of demands on those resources. How do you decide where to allocate them so that everything runs smoothly and efficiently? That's what we'll be talking about. First off, let's understand the basics. We need to consider several factors: available budget, manpower, time constraints, and project priorities. By looking at these elements together, we can start making sense of how best to spread our resources around. Now, let's talk about setting up a framework for this distribution process. Start by identifying all your projects or tasks that require resource allocation. List them out clearly with their specific needs, whether it's financial investment, manpower hours, or equipment usage. Next step is prioritization. Not everything can be given the same amount of resources. Some tasks are more critical than others and will need a higher share of the available resources. Here's where you bring in your strategic thinking. Use criteria like project importance, urgency, potential return on investment to decide which projects should get priority. Once priorities are set, we move on to allocation. Distribute your resources based on these priorities while also ensuring there's enough wiggle room for contingencies or unexpected demands that might pop up later. It's a bit like planning your finances. You allocate funds for necessities first and then see what's left over for other expenses. Now, let's talk about monitoring and adjusting this distribution. Resources aren't static, they're dynamic. As projects progress, their needs change too. Regular check-ins help identify any gaps or excesses in resource allocation and allow adjustments to be made accordingly. This ensures everything stays on track towards achieving your goals efficiently. So there you have it. The process of determining optimal resource distribution involves identifying what resources you have, prioritizing based on project importance, allocating those resources effectively, and then regularly monitoring to make necessary adjustments. It's all about using available tools wisely while keeping an eye on overall objectives. Remember, every situation is unique, so tailor this approach according to your specific needs and circumstances. The key takeaway here is that effective resource management leads to better productivity and smoother operations overall. All right, everyone. Welcome back to our financial literacy series where we dive into making smart money moves. Today, we're going to explore how to make investment decisions that can lead to portfolio success. Let's start by understanding what it means to have a successful portfolio. It's about achieving your goals, whether that's saving for retirement, funding education, or building wealth over time. Now, the first step in creating a successful portfolio is determining your risk tolerance and investment objectives. Think of it like choosing between high-risk stocks with potential for big gains and low-risk bonds providing steady income. Your age, financial situation, and goals will all play a role here. Next up, diversification, spreading your investments across different asset classes to manage risk. This can include a mix of equities, fixed income securities, real estate, and even alternative assets like cryptocurrencies or private equity. Now, let's talk about the nitty-gritty of investment strategies. You've got options from value investing to growth investing, income generation, and beyond. Value investors look for undervalued stocks they believe will eventually return to their true worth. growth investors are all about finding companies with strong potential for future earnings growth. Another key aspect is understanding market trends and economic indicators that can influence investment performance. For example, interest rates, inflation, geopolitical events, these all have a say in how your portfolio performs. It's important to stay informed and adjust your strategy as needed. Don't forget about rebalancing your portfolio regularly to maintain your desired asset allocation. This ensures you're not drifting too far from your original investment mix due to market movements or performance differences between assets. Lastly, always keep an eye on high-cost investments can eat into your returns over time. Look for low-cost index funds and ETFs if passive investing suits you. So there you have a basic framework for making informed investment decisions that align with your financial goals. Remember, investing is a marathon, not a sprint. It's about patience, persistence, and staying focused on long-term outcomes rather than short-term market fluctuations. Thank you all for joining me today. I hope this insight helps you navigate the world of investments more confidently. Today, we're diving into the world of product lifecycle stages. It's like understanding the lifespan of your favorite products from birth to retirement. So let's get started. First up, we have introduction, the early days when a new product hits the market. This stage is all about creating awareness and gaining traction with consumers. Companies spend a lot here on advertising and marketing to introduce their product to as many people as possible. Next comes growth, where the product starts gaining popularity, sales increase significantly, and more customers start buying it regularly. It's like when your favorite snack becomes widely available in supermarkets everywhere. Then we hit maturity. This is when the product has reached its full potential, sales are steady, and competition might be high. Companies focus on maintaining their market share through innovation or marketing tweaks to keep consumers interested. Finally, there's decline as newer products come along with fresh features or better technology. Older products start losing ground. Sales drop off slowly at first, but then can decline more sharply if the company doesn't act quickly enough to revamp the product or find new uses for it. Each stage requires a different approach and strategy from marketers and businesses. Understanding these stages helps companies anticipate changes in consumer demand and adapt their marketing efforts accordingly. So there you have it, an overview of the product lifecycle stages: introduction, growth, maturity, and decline. Remember, each phase is important as they all contribute to the success or longevity of a product on the market. That wraps up our discussion today about understanding product lifecycle stages. All right, everyone. Today, we're diving into some key strategies for managing different life cycle phases in business operations. It's important to understand that every stage of your company's growth requires unique approaches and considerations. Let's start with the initial phase, often called the startup or early stage phase. This is where you're laying down the foundation for your business. At this point, focus heavily on market research and identifying your target audience. You'll also want to establish a clear value proposition that sets you apart from competitors. In terms of financial management, be mindful of cash flow, since high-ticket expenses can quickly deplete startup capital. Moving into the growth phase, things start picking up speed. Here's where scaling becomes crucial. Develop strategies for expanding your team and increasing productivity without sacrificing quality. Pay attention to customer feedback and adjust accordingly. Building strong relationships with suppliers and partners will also help in sustaining steady growth. As you approach maturity, consider diversifying revenue streams or venturing into new markets. This can provide stability during economic fluctuations. It's also a good time to invest in technology upgrades that improve efficiency and innovation. Remember, staying ahead of industry trends is vital for maintaining competitive advantage. Lastly, as we look at the later stages, such as consolidation or decline phases, focus on optimizing existing processes and trimming unnecessary costs. Explore opportunities for mergers or acquisitions if appropriate. Effective management during these phases can lead to smoother transitions and better outcomes overall. To summarize, managing different life cycle phases requires flexibility and strategic planning tailored to each stage's unique needs. By focusing on key areas like market positioning, financial management, relationship building, innovation, and process optimization, businesses can navigate through various growth stages successfully. That wraps up our discussion today on managing different life cycle phases in business operations. All right, everyone, let's dive into today's topic: encouraging innovation in your portfolio. Innovation isn't just about coming up with new ideas, it's also about nurturing those ideas and seeing them through to completion. So, how do you encourage this kind of thinking within your own work? First off, start by setting a conducive environment for creativity. This means giving yourself permission to explore new avenues without fear of failure. Remember, every innovative idea started somewhere, usually with lots of experimentation and trial and error. Next, take some time each day to brainstorm or reflect on ways you can improve existing projects or introduce entirely new ones. It could be as simple as rethinking the layout of a high-ticket project or exploring unconventional solutions for your nitty-gritty tasks. Another key aspect is collaboration. By working with others, you expose yourself to different perspectives and ideas, which can spark innovative thinking in unique ways. Think about partnering up with colleagues who have diverse backgrounds or skills. This can really shake things up. Lastly, don't forget the importance of continuous learning. Stay updated on industry trends, read books related to your field, attend workshops or seminars. The more you know, the better equipped you are to innovate. In conclusion, fostering innovation in your portfolio is all about creating a space for creativity, regularly brainstorming new ideas, collaborating with others, and never stopping your quest for knowledge. So go ahead and start innovating today. All right, everyone. Welcome back to our session on developing and launching new products successfully. Today, we're going to dive into some key strategies that will help you not only bring your innovative ideas to market, but also ensure they stick around for the long haul. Let's start with understanding the importance of market research. Before anything else, it's crucial to know who your target audience is and what their needs are. Conducting surveys or focus groups can give you valuable insights into consumer behavior and preferences. This step might seem time-consuming, but trust me, it will save you headaches down the line by ensuring that your product meets real-world demands. Next up, we'll talk about prototyping. A prototype allows you to visualize your concept in a tangible way and gather feedback early on. It's much easier to make changes at this stage than after launch, when costs can skyrocket. Remember, prototypes don't have to be perfect, they just need to demonstrate the core functionality of your product. Now let's move on to pricing strategy. Setting the right price for your new product is crucial. You want it to be attractive enough to draw customers while also covering your production costs and making a profit. High-ticket items might require a different approach compared to everyday consumables, so consider the nitty-gritty details of your market carefully. Marketing plays an essential role in launching any new product successfully. Creating buzz through social media, influencer partnerships, or even traditional advertising channels can really boost visibility and interest. Don't forget about SEO. Optimizing your website for search engines ensures that potential customers find you easily online. Finally, customer support is key to maintaining a loyal user base. Providing excellent after-sales service shows customers they're valued and encourages repeat purchases or referrals. Collecting feedback through surveys or reviews also helps fine-tune future product iterations based on real-world usage. In summary, successful new product launches hinge on thorough planning and execution across several fronts: market research, prototyping, pricing strategy, marketing efforts, and customer support. By addressing each of these areas thoughtfully, you'll be better equipped to bring your innovative ideas to life and see them thrive in the marketplace. So there you have it, folks. I hope this gives you a solid foundation for developing and launching new products successfully. All right, everyone, let's dive into today's topic: building effective cross-functional teams. Now, you might be thinking why this is important. Well, imagine having a team where every member brings unique skills and perspectives to the table. That's what cross-functional teams are all about. These teams can tackle complex projects more efficiently because they pool together diverse expertise. Let's start with understanding what makes these teams tick. First off, it's crucial to have clear goals and objectives. When everyone knows exactly what needs to be achieved, it keeps the team aligned and focused on success. Next up is communication. Open lines of dialogue are key for cross-functional teams because they ensure that everyone stays informed about progress and any changes along the way. Now, let's talk about roles and responsibilities. Each member should have a defined role so there's no overlap or confusion. But here's an important point. These roles should be flexible enough to accommodate different expertise levels when needed. This flexibility helps in addressing various challenges that might pop up during project execution. Another essential aspect is fostering collaboration among team members. Encourage teamwork by setting regular meeting times for updates and brainstorming sessions. This not only keeps everyone on the same page, but also promotes creativity and innovation within the team. Make sure to leverage technology tools like Slack or Microsoft Teams to facilitate seamless communication and file sharing. Leadership plays a vital role too. A strong leader who can guide the team through challenges, mediate conflicts if they arise, and celebrate successes is crucial for maintaining morale and driving productivity. Remember, leaders should lead by example, showing commitment, dedication, and passion for the project's success. Lastly, it's important to measure progress and celebrate achievements along the way. Regular check-ins and performance evaluations help keep everyone motivated and on track towards meeting their goals. And don't forget to recognize individual contributions. Acknowledging each team member's hard work boosts overall morale and keeps them engaged. In conclusion, building effective cross-functional teams requires clear communication, defined roles, collaboration, strong leadership, and regular feedback. By focusing on these key elements, you can create a cohesive unit that excels in achieving high-ticket objectives while enjoying the journey together. Thank you for joining me today. Today, we're diving into how collaboration can boost our teamwork and lead to better outcomes. Imagine you're part of a high-ticket project where everyone's contribution is crucial. When team members work together seamlessly, they not only enhance their individual roles, but also elevate the group's overall performance. Let's start by understanding what makes great collaboration. Firstly, clear communication is key. Everyone needs to be on the same page about goals and expectations. Next up is respect for each other's expertise. By valuing different skills and perspectives, teams can tackle challenges from multiple angles. And don't forget about trust. It fosters a safe environment where team members feel comfortable sharing ideas openly. Now, let's talk about some practical tips to improve collaboration within your group. Start by establishing regular check-ins or meetings to ensure everyone is aligned and aware of progress. Use tools like shared documents or project management software for easy access to information and updates. Also, make sure to celebrate achievements together. This boosts morale and strengthens bonds. Another important aspect is managing conflicts effectively. When disagreements arise, view them as opportunities to learn and grow rather than roadblocks. Encourage open dialogue where team members can express their thoughts constructively. By addressing issues early on, you prevent them from becoming bigger problems down the line. Lastly, embrace diversity within your team. Different backgrounds bring unique viewpoints that enrich collaboration. Foster an inclusive environment where everyone feels valued and heard. This not only leads to better outcomes, but also makes working together more enjoyable. In conclusion, by fostering strong collaboration through clear communication, respect for expertise, trust building, regular check-ins, conflict resolution, and embracing diversity, teams can achieve remarkable results. Remember, The success of your project depends on how well you work together as a team. That wraps up our lesson on facilitating collaboration for better outcomes. All right, everyone, let's dive into today's topic, which is all about regular portfolio reviews and assessments. Now, these are key practices that help us stay on top of our game when it comes to managing our investments effectively. First off, why do we need to review our portfolios regularly? Well, think of it like checking your car's oil every few thousand miles. It's a simple act, but can tell you a lot about the health and performance of your vehicle. Similarly, reviewing your portfolio regularly gives you insights into how each investment is performing and helps you make informed decisions. When we talk about regular reviews, we're looking at doing this quarterly or even monthly for some investors. This frequency lets us catch any significant changes early on and adjust our strategies accordingly. For example, if a stock in your portfolio has seen a sharp decline, you might want to reevaluate its position or consider selling it off if it no longer aligns with your investment goals. Now, let's talk about assessments. Assessments are more comprehensive than reviews and usually happen annually. During these times, we're looking at the big picture: how well our portfolio is diversified, whether our asset allocation still fits our risk tolerance, and any new opportunities or potential risks that have emerged over the year. It's like doing a full-body checkup for your investments. An important part of assessments involves comparing your current holdings against benchmarks or performance goals you've set. This helps us see if we're meeting expectations or need to make some changes. Remember, it's not just about beating the market. It's also about staying true to your investment strategy and risk profile. Another key aspect is rebalancing the portfolio during these reviews and assessments. Over time, as investments grow or shrink in value, your original asset allocation can get out of whack. By bringing everything back into balance, you maintain your desired level of diversification and exposure to different types of assets. Finally, don't forget about tax implications when making adjustments based on your portfolio review findings. Some moves might trigger taxable events, so it's good practice to consult with a financial advisor or before making big changes. In conclusion, regular reviews and assessments are crucial for managing your investments effectively and staying aligned with your long-term goals. By doing these regularly, you can ensure that your portfolio stays healthy and continues to perform well over time. All right, let's dive into section 10.2 of our investment journey, making necessary adjustments to your portfolio. Imagine your portfolio like a garden that needs regular care and attention. Just as you prune plants and add nutrients to keep them healthy, we'll discuss how to maintain and adjust your investments for optimal performance. First off, let's talk about the importance of rebalancing. Over time, some assets may grow faster than others, causing the overall mix of your portfolio to shift. For instance, if stocks have been performing exceptionally well recently, you might find that they now make up a larger portion of your total investment compared to bonds or real estate. This is where rebalancing comes into play. By selling off some high-ticket assets and reinvesting in others, you can maintain the desired asset allocation. Next, let's consider the impact of market conditions on your portfolio. When economic indicators change, it may be time to rethink your investment strategy. For example, if inflation is rising, you might want to shift towards investments that traditionally do better during such periods, like real estate or commodities. On the other hand, if interest rates are dropping, high-yield bonds could become more attractive. Another aspect to consider is diversification. Even with a well-balanced portfolio, it's crucial to regularly review your holdings and ensure you're not overly exposed to any single asset class or sector. This helps mitigate risk and can lead to better long-term returns. Lastly, don't forget about the nitty-gritty details such as fees and tax implications. High management fees can eat into your profits over time, so it's important to periodically review these costs. Additionally, paying attention to how different investment options are taxed can help you save money and optimize your portfolio's performance. In conclusion, adjusting your portfolio is an ongoing process that requires regular attention and a bit of tweaking here and there. By rebalancing, adapting to market conditions, diversifying, and managing fees and taxes, you can ensure your investments stay aligned with your financial goals and help achieve the returns you're looking for. Thank you all for joining me on this journey through managing product portfolios for business success. Over the past weeks, we've covered everything from understanding the basics of product portfolio management to setting strategic direction and aligning products with business goals. We explored how to assess market trends and customer needs, evaluate performance metrics, and conduct risk assessments to ensure a robust portfolio. The course also delved into resource allocation, managing different stages of product life cycles, fostering innovation and collaboration across teams, and finally, the importance of monitoring and adjusting your portfolio regularly. The most important takeaway is that effective management of your product portfolio isn't just about launching new products or improving existing ones. It's about making strategic decisions based on data, trends, and customer insights to maximize overall business value. By aligning your portfolio with your company's strategy and continuously evaluating performance metrics, you can make informed investment decisions and manage risks effectively. I encourage all of you to apply these concepts in your work and see how they can enhance the success of your product portfolios. Whether it's launching a new product or optimizing an existing one, remember that understanding market trends and customer needs is key. Also, don't forget the importance of collaboration across teams and regular reviews to keep your portfolio on track. As you move forward in your career, I wish you all the best in managing your product portfolios successfully. Please feel free to connect with me if you have any questions or want further guidance. Additionally, leaving a review for this course would be greatly appreciated as it helps others who are looking to improve their product portfolio management skills. Thank you once again for being part of this learning experience, and here's to your future success in business.